Thank you, Irish. And now let's proceed to another report that will be given to us by Bayamina Haji Ismail from Coronel City.
So let us first define what transportation in is, or also called as freighting. Transportation in is cost incurred to deliver inventory from a vendor or a supplier to the buying entity. Transportation in costs are included in the inventory cost or the product cost. It may include shipping and insurance costs. It means that transportation in is either shipping fee or insurance cost included in the inventory cost that the buyer purchases. Here are some cases regarding transportation in. Case number 1. Assume that GD Toya traders made purchases totaling 17,000 pesos FOB destination, freight prepaid, terms 2/10, N/30. 2/10 indicates that if the borrower will pay within 10 days, there will be discount of 2%, while as N/30 indicates the time period that is given. N stands for net, or the total amount that the borrower will pay within 30 days. Transportation cost amounted to 1,900 pesos. Here's the table for case number 1. Assume the date is November 25. On debit side, purchases, credit side, accounts payable. There is no debit to transportation in account since the shipping term provided that the seller should shoulder the transportation cost as it's stated in the problem, the FOB destination, which means the seller should be the one to pay the transportation cost. In addition, the seller prepaid the freight. If this invoice is paid on December 5, the purchases discount will be 340 pesos, computed as 17,000 multiplied to 0.02%. From November 25 to December 5, if the borrower could be able to pay within 10 days, then he or she would avail the discount of 2%. On debit side, accounts payable 17,000. Credit side, purchases discounts 340. On credit side, cash 16,660. Case number. Assume that GD Toya traders made purchases totaling 17,000 pesos FOB shipping point, freight collect, terms 2/10, N/30. The transportation cost amounted to 1,900 pesos. Here's the table for case number 2. The date is November 25. On debit side, purchases 17,000 pesos. Debit side, transportation in 1,900 pesos. On credit side, accounts payable 17,000 pesos. Credit side, cash 1,900 pesos. There is debit to transportation in account since the shipping term provided that the buyer should be the one to pay or should shoulder the transportation cost as it stated the FOB shipping point. If this invoice is paid on December 5, the purchases discount will be 340 pesos from November 25 to December 5. Transportation in will form part of the net cost of purchases. On debit side, accounts payable 17,000 pesos. Purchases discounts on credit side 340. Cash on credit side 660,000 pesos, totaling 17,000 pesos. They differ from the shipping term. Value-added tax entries. The foregoing entries for sale and purchases did not incorporate the effect of the value-added taxes on the transaction to simplify the illustrations. But the learning will not be complete without the following illustration. Knowledge gained from this section will prove useful in accomplishing the supplement to this test. Here's the illustration. Remedios Palaganas Feeds based in Pangasinan trades specialty feeds for raised horses, fighting cocks, aquarium fish, zoo animals, and other animals generally considered as pets. On May 13, 2019, Remedios Palaganas Feeds purchased on account specialty feeds with a total amount payable of 784,000 pesos. A wholesaler operating in the region disposed for cash all of the available fees on May 25, 2019. Amount of cash received was 1,120,000 pesos. Remedios Palaganas Feeds paid the value-added tax due by month and not minding the actual deadline. Here's the table for the illustration that is given. On May 13, 2019, debit side purchases 700,000 pesos, debit side input tax 84,000 pesos. On credit side, accounts payable 784,000 pesos. On May 25, 2019, debit side cash 1,120,000, credit side sales 1 million, credit side output tax 120,000 pesos. On May 31, 2019, debit side output tax 120,000 pesos, credit side input tax 84,000, credit side VAT payable 36,000 pesos. On May 31, value-added tax payable 36,000 pesos on the debit side. On credit side, cash in bank 36,000 pesos.
Net sales. Net sales is the first part of the merchandising income statement. Net sales reflect all reductions in the price paid by customers, discounts on goods, and any refunds paid out to customers after the time of sale. These three deductions have a natural debit balance where the gross sales account has a natural credit balance. Thus, the deductions are constructed to offset the sales account. For example, Gloria de Toya Traders partial income statement for the year ended December 31, 2019. Beginning net sales is 2,463,500 pesos, less sales returns and allowances of 27,500 pesos and sales discounts of 42,750 pesos. Total net sales is 2,393,250 pesos. Gross sales. Gross sales is a metric for the total sales of a company, unadjusted for the costs related to generate those sales. Under accrual accounting, revenues from the sale of merchandise are considered to be earned in the accounting period in which the title of goods passes, usually at the point of delivery, from the seller to the buyer. Gross sales consists of total sales for cash and on credit during an accounting period. Although cash for the sale is uncollected, the revenue is recognized as earned at the time of the sale. For this reason, there is likely to be a difference between net sales and cash collected from those sales in a given period. As an income account, the sales account is credited whenever sales on account or cash sales are made. Only sales of merchandise held for resale are recorded in the sales account. If a merchandising firm sold one of its delivery trucks, the credit will be made to the delivery equipment account, not to sales account. The journal entry to record the sale of merchandise for cash is as follows. September 16. Cash. Debit, 25,000 pesos. Sales, credit, 25,000 pesos. To record sale of merchandise for cash. If the sale of merchandise is made on credit, the entry will be September 16. Accounts receivable. Debit, 25,000 pesos. Sales, credit, 25,000 pesos. To record sale of merchandise on credit.
Now let us discuss what operating expenses are. Operating expenses makes up the third major part of income statement for merchandising entry. These are expenses other than the cost of sales which are incurred to generate profit from entity's major line of business, merchandising. It is customary to group of operating expenses into useful categories: distribution cost, administrative expenses, and other operating expenses are the three categories of operating expenses. First, let us know what distribution of cost or selling expenses is. These are those expenses related directly to the entity's effort to generate sales. These include sales salary and commission, and related employer to payroll expenses, advertising and store displays, traveling expenses, store supplies use, depreciation of store property and equipment, and transportation out. This includes all expenses that is related and connected directly to the business. Next, let us know what administrative expenses is. These are those expenses related to general administration of the business. This includes officers and office salaries, and related employer payroll expenses. Office supplies are used, depreciation of office property and equipment, business taxes, professional services, uncollectible accounts expense, and other general office expenses. Lastly, other operating expenses are those expenses that are not related to the central operation of business. These are expenses and losses from peripheral or incidental transaction of the enterprise. For example, loss in sales of investment or loss of sale on property and equipment. So our next lesson will be periodic and perpetual inventory system compared. Let us assume that the beginning inventory of the whole year is 250,000. Assuming the transactions were the only transaction for the entire year, the balance in the inventory account to year end under the periodic inventory system is 250,000 pesos. The year-end balance in the inventory account under perpetual inventory system would be 231,860 pesos. Under the perpetual inventory system, the inventory account is increased by purchase transportation in and sales return is decreased by the cost of sale, purchase returns and allowances, and purchase discount. At the year-end, the physical inventory is taken into a relieved and actual inventory on hand is 231,500 pesos. The year-end journal entries are then made to bring the inventory account balances into agreement with the amount of physical inventory. When posted on General Ledger, both the periodic and perpetual inventory system result in the same ending inventory amounting to 231,500. So for further understanding, we have here in the screen examples of periodic and perpetual inventory system. For number 1, we sold merchandise on account costing to 8,000 pesos for 10,000 terms worth 2/10 and n/30. Account receivable is debited on periodic inventory system amounting to 10,000 and credited sales of 10,000. On the other hand, in perpetual inventory system, account receivable is debited and sales is credited, also amounting to 10,000, and the cost of sale is 8,000 and inventory is 8,000. Number 2. Customers receive merchandise costing to 400 pesos that have been sold on account for 500, part of the 10,000 sale. So, in periodic inventory system, sales return and allowances will be debited amounting to 500 and credit the account receivable amounting to 500. On perpetual inventory system, we would credit inventory amounting to 400 and cost of sales is also 400 from the sales return allowances that is debited by amounting to 500 and account receivable amounting to 500 as well.